And we're live.
Bit of a premature intro on my part there. I forgot you're going to be triggering that. This is our
That's
first
right.
time going live like this, so we've got a couple kinks to work out, but welcome if you are joining us here. We got some news to be sharing with you, so make sure you subscribe to the channel because I am going to be doing this several times a day with different economic, real estate, mortgage, what if it involves your wealth and it involves your quality of life. I'm going to be going live and sharing the news with you. So we've got an awesome way to be kicking this trend off. I'm joined here by Kyle Ranke, the COO of the David Green team, and Christian Batchelder, the COO of the One Brokerage. And we've got some very exciting news about the mortgage industry. This is the most excited that I have heard Christian sounding since the McRib was back at McDonald's.
Okay,
come on.
I know this is big news. Christian, first off, who is today's message for? Who should be paying attention to this?
Yeah, big shaking up news updates for those in high value markets specifically who are looking to house hack via purchasing a multi-unit property. Multifamily. This is 2, 3, and 4 unit residential properties. It's going to be big updates for you guys. Going to allow you to qualify in situations where you couldn't before. Really cool, big update for those of you looking for some house hacking opportunities.
Okay, so for context here, previously, if you wanted to buy small multifamily, 2, 3, 4 unit properties, you would put what, 10% down for a duplex and 15 to 20% down for 3 or 4 units?
A small edit to that, just in terms of 1 to 4, 5% down for 1, 15% down for a duplex, 20% down for a 3 unit, 25% down for a 4 unit. That's historically what it's been. Some lenders will allow you to do 20 on a 4 unit as well. But that's
even worse than I thought.
Yeah.
Now, this is a thing that Christian and I have got back and forth with. I remember in my mind a time where you could put 5% down on 2, 3, and 4 unit properties. And I've operated as if that's the truth. I meet Christian. He's like, no, I don't think that was ever the case. He is younger than me, so I might be right. Kyle and I have had the same argument about other things like Looney Tunes and what else, Kyle, have we talked about if it ever actually existed?
Oh, man, there's a lot of things. The moon landing, we've talked about that before.
No, but isn't there a word that you have to describe when people remember something differently than what it was?
Mandela effect. Is it the Bernstein Bears or the Bernstein Bears?
Yes.
That's what we're getting at. Exactly. Was it the Bernstein Bears? How is Looney Tunes spelled? What do you guys think? Let me know in the chats. How was Looney Tunes supposed to be spelled? Kyle, what are some other things that we've tried to remember if they're true?
Let me see here. I'm going to pull up some different ideas of things that I have seen in the past. Can you explain what the Mandela effect is, Christian, and where it comes from?
I don't know if I know that. I know it's stuff that it's so funny. I've seen where people even record stuff on an old Nokia, right? And I'm sure it's edited, but it comes through different because it's being recorded from like past technology. I've definitely heard the Bernstein Bears one. I don't know what the sources of the Mandela name though.
The idea of the Mandela effect is that people remember things differently than what they were. And it's weird. So I got everybody spelling Looney. It's actually the Tunes part of Looney Tunes. I should have clarified this. How do you spell tunes in Looney Tunes? So everybody is like, it's funny. Everybody in my Instagram is typing away right now. But the idea would be like, was it true or was it not true? It's hard to tell. You have to ask people and rely on their memory. So I think that there was a time you could put 5% down on small multifamily, but it doesn't matter because it went away. The rule has been, like Christian said, 15% on a duplex and then 20% or more on a triplex or a fourplex, which meant you had to use an FHA loan if you wanted to put low money down on small multifamily, which was 3.5%. The downside of that is FHA comes with a self-sustainability rule. Christian, can you describe what that is and how that rubs salt in investors' games?
Yeah, and this is specifically why this is catered towards high value markets. Think the Los Angeleses, the San Franciscos, the Miamis, the New Yorks. Typically how it works, not typically, exactly how it works is, so let's say you buy a 4 unit FHA loan. Technically, you can buy an FHA 4 unit with 3.5% down. Technically, that's possible. The downside is it comes with an underwriting criteria where you would add up all 4 units rental income. Let's say it's $1,000 a unit. You'd have $4,000 total. And then you have to take a 75% haircut. So that $4,000 goes down to $3,000 in this example. That $3,000 has to be equal or greater than the entirety of your mortgage payment, principal, interest, taxes, insurance, and mortgage insurance included. You guys can understand why now in high value markets with rates and prices being where they are, there's not going to be that after that 75% haircut, you're not going to make enough money to counteract the entirety of the mortgage. And that's not an underwriting guideline where, oh, if I just make more money, I can compensate that. No, it's a flat decline. You will not get a 3 or 4 unit rental property with an FHA loan if that situation is not in equilibrium. Okay. That's why we're excited to bring today's announcement, because we have an alternative now.
All right. So if somebody wants to buy a small multifamily, well, let me back up a step. Cash flow is very hard to find. Small multifamily is traditionally the best way to get cash flow. The problem is people don't always think about the difference between a 5% down payment and 20% down payment is remarkably different. You were talking about 4 times as much money, which means you'd have to save money for 4 times as long to buy the same property. It is almost impossible to scale unless you're incredibly wealthy if you have to put 20 or 25% down on every property. 5% down is much more manageable. The problem is you can only buy single family residential homes with a 5% down loan. So we've started talking about what I call real estate goggles, having the ability to look at a property and say, how could I take a single family and turn it into a multifamily property, which can work with 5% down, but then you're going to have a rehab budget and it's harder. This opens doors that have not been open for a long time. 5% down on small multifamily, which should get more cash flow. And you don't have to worry about the self-sustainability role. Guys, for those of us that are in the industry, this is huge because this messes up things all the time. We always have people that we get in contract with FHA loans and then it blows it. So Christian, what about county conforming limits? What do people need to know about those?
Yeah. And this varies across the entire country, but depending on the county that you're located in, there is a limit that you can get a standard conventional loan. This is a Freddie Mac or a Fannie Mae loan, based on the unit count of the property. A true single family property will have a number. Let's say, in most markets in California, that's between like 700,000 and $1 million. These typically go up every year with appreciation, right? So they bump up and down. That means a duplex may be 1.1 million. A triplex may be 1.2, a quad may be 1.4, right? So it varies by county. These are publicly Googleable data points. So you can Google Fannie Mae loan limits and put in your zip code, and you can find these for your specific property. If you're doing a pre-approval with us, we take care of this for you. We make sure we don't pre-approve you over the county loan limit, where then you have to jump into a jumbo loan that does not play by these same rules. So these are guideline changes for Fannie Mae and Freddie Mac loans specifically.
All right, we are sharing the screen right now. Christian, can you briefly describe what we are looking at, who releases this, and how you understand this information?
Yeah, well, I would love to take credit for it. I see Mark's question here. Is this an alternative that you guys have created, or is it a change in the industry? I'm going to say it's a combination of both. I'm actually on a couple consulting panels with a couple of our lenders that have some influence and ability to, give a lot of feedback to Fannie Mae. By no means am I taking credit for this, but what I am saying is this has been something that we have been requesting relentlessly, right, for years now. And it's finally happened. So it's probably a combination of us, other brokers, lenders across the board that have put enough pressure on Fannie Mae where this has changed. The only thing that's changed, if you guys can see this chart that David's sharing, is those red numbers. So you see, we're looking at LTV ratios. The first box says transaction type purchase. The next boxes are 1 unit. That's always been 5% down, or with rare situation for a first-time home buyer, you can actually put 3% down. That's why it says the LTV is 97 or 95. Okay. FRM and ARM stands for fixed rate loans and adjustable rate loans. We don't do a whole lot of adjustables, but the fixed rate loans is really what you're looking for. It's technically a minimum down payment of 3. Most products have a down payment of 5. Okay. Now look at what 2 units we're at. 2 units were requiring 15% down. So you guys see where it says currently 85%. That means that you can get a loan for 85% of your purchase. Now look at the red number, 95, baby. You can put 5% down and get a 2 unit. Even stronger than that, go to the 3 and 4 unit. It was currently at 75%. That's the 25% number, right? That's a huge number. Now 3 to 4 units, you can put 5% down. That's incredible. This is a massive change. And like David shared, prior to 2008, I was not a loan officer prior to 2008. Very possible these were available. Since 2008, these guidelines for down payments on 1, 2, and 3 units have been fairly stable. There have been small changes, with one exception, and those have been income restriction loans. Those are loans where there are we call them AMIs. They're area median income limits, and they're kind of a thorn in the heel, so to speak, right? Because they say, we'll give you this loan and you could put 5% down on a triplex, but you can't make more than $80,000 a year, let's say, right? And area median incomes is very similar to county conforming loan limits that we talked about. They're set per the county that you live in, right? The problem with that is that it's a catch-22. If you make less than the area median income, you don't make enough money to qualify for a mortgage. So even though this mortgage product is available, it's not available to anybody, right? Unless you're buying out in like, Kansas or something, where the area median income limit and the purchase prices are more in unison. That's why I led off by saying this is specifically impactful for people looking to house hack or buy multifamilies in higher value markets. I do see Mark says it does take place. It does technically roll out November 18th. That's the first day we can fund them. That just happens to be around 30 days from now, right? So we can start looking for properties like this, start pre-approving people, and we can close these as early as November 18th.
Christian, if people want to reach out to you to get pre-approved for one of these or learn more about loan options, where do they go?
Oh, this big Kyle's way ahead of me there, aren't you? Big green bar at the bottom of the page. Intake at theonebrokerage.com is our direct email. If you guys see David on social media, see me on social media, you can message us there. I'm at the One Broker on Instagram. I think TikTok, all the stuff. You guys can message me anywhere that you see me. If you pull up the page and it's just some nerd talking about mortgages, you probably found the right guy. But outside of that, yeah, I mean, it's awesome change that we've needed for a long time, because as David shared, FHA loans for triplexes and quadplexes don't work anymore. You can hardly do them outside of very, very few and select markets in the country. They're off limits for pretty much every market that has the majority of people. And this is an awesome alternative now that we're really excited about. Literally today. This came out today, guys. You are hearing this like hot off the press.
First people to break it. Yeah, it's leveling the playing field. So like guys like me, that's good. They're going to have bigger down payment options. We can go in and buy these fourplexes and put 20% down, 25% down. And it kind of pushes out the people that don't. So if you are somebody who's had a hard time saving up 20%, 25% to buy a small multifamily property, you should be jumping for joy right now. Also, I would expect to see an increase in demand for these assets. That's why we're going live right now, so that you can get this information before everybody else hears about it. Kyle, what would you expect to see in the markets that you're serving when it comes to the demand in the MLS for these 2, 3, and 4 unit properties with this new loan product once it catches on?
Yeah, I think demand is definitely going to go up. You're going to see a lot more house hackers. You're going to see a lot more competition for these types of properties because the barrier to entry is a lot lower now. You don't need as much capital to get into these 2, 3, 4 unit properties. So I would expect the competition to increase, even though the interest rates have gone up. Multifamily, specifically where I serve in Northern California, has traditionally been very, very competitive because everybody's looking for that cash flow, right? And so now that there's going to be more options and more opportunities, you're definitely going to have more competition. So if you're looking to sell multifamily too, maybe you're an investor who's they're at the end where they want to get rid of their properties. This could be a really good option and opportunity to do so now that you're going to have a bigger buyer pool.
That's it. So if you're looking to sell, Kyle, how can people reach out to you if they want to talk about buying or selling real estate?
Yeah, you can email me at kylerenke@kw.com. I'm also on Instagram, Kyle Renke. That's KYLERENKE.
All right. So how this affects everyone, to wrap up, and what we should do with this information going forward. One, if you own small multifamily property, wait a couple weeks here. You should start seeing more people getting pre-approved to buy it, or a couple months for sure. You should see increased demand. This could be even more powerful if you time it with the spring market going into next year. So at the time when more buyers are coming out and news about this program has made its way through the rounds, you're going to have more buyers pre-approved at the same time that more people are looking to buy. Boom, you're going to see a pretty big increase in demand and probably in the prices that people are willing to pay for these assets. If you're somebody who's looking to buy real estate in this asset class, 2, 3, and 4 units, jump on it now. Try to get in before everybody else finds out about this, and you get more competition from other people, especially because we are starting to head into winter months, which is typically when you have more leverage as a buyer. So now you're getting more leverage and you're getting a better loan product. That's a double win for you if you're buying, if you time this right. And if you're someone who is using an FHA loan, don't save that sucker. Instead, use a conventional loan with 5% down in most cases, because you don't have the self-sustainability rule. You won't have mortgage insurance that doesn't go away. Christian, on a loan like this, the mortgage insurance should go away once they hit 80% loan to value, correct?
78 to 80, depending on the terms of the product. Yes.
Okay, so it's usually a better product than FHA. Now, of course, speak with your loan officer, talk to the expert, go over your plan. But in general, this is the way that you want to bring the conversation up to them. And for everybody else, keep following the channel here. Make sure you subscribe to this, like, and share so that you get notified about changes in the industry, what's going on in the economy, and how you can equip yourself with the information that you need to make better decisions today. Kyle, Christian, thank you for joining me. I will see you guys on the next one.
Awesome.
Thank you, David.